let's move on. So have realistic expectations. This is absolutely critical. You see a lot of these kind of like misguided adverts out there which try and lure you in with kind of like, you've seen the computer spitting out wads of cash in these images and montages of like Ferrari parked outside your mansion on, in Miami, and all of this. If only you can give the company with the advertisement a couple of $1,000s in receipt of some kind of bottle, something like that, which apparently is going to double your account. If it's too good to be true, it generally is. So just as I said to you earlier, trading is not a get-rich-quick scheme. The market does not owe you anything just for turning up, and it certainly doesn't owe you anything for actually doing your market analysis. Just accept that's part and parcel of trading. Even if there's nothing to trade, you still have to do market analysis and look to see what's available. All right? Remember that not being in the market, a decision to not be in the market is a valid trading decision. You've made a valid decision not to put your capital at risk. And as a lot of people don't realize when they're new to the markets, is capital preservation is the first objective of any trader. The second objective is to make money. Okay, the number of strategies you trade does not equal more money, i.e. the more strategies or the more trades you place does not equal more money. Losing the battle is part of winning the overall war. Okay, you can make as much money or as many pips trading a strategy which yields you only 3 to 5 or let's say 3 to 10 setups a month on the daily time frame as you can trading intraday. But the great thing about trading the daily time frame, of course, is that you do not spend as much time trading it than you would if you're intraday trading. And when you're looking at a time versus money return, if you had a winning month, then if you're trading the daily time frame, you've had a much better time return compared to if you've traded intraday, if you've got the same result. Conversely, if you've had a drawdown for the month, people who trade intraday versus people who trade end of day, the people who traded end of day would have done better because at least if they drew down like the intraday traders, they would have spent far less time doing or sustaining that drawdown. Okay, so remember, whatever happens, slow and consistent gains can be made over time if you have the right edge, risk management, and the winning attitude. Know your strategy and when not to trade. I mentioned that, and I'll mention it again before we all depart as friends in about half an hour's time. So risk management, moving on. This is critical. Again, I know a number of you are probably familiar with this, but it doesn't mean that it's lost any of its raison d'etre since you probably heard the last person talking about it. We need to treat our trading account as our fund, as our business essentially, and we should never trade with more money than we can afford to lose. I'm sure you've heard me say that before, and guess what? I'm going to say it again just in case, because a lot of people, they say repetition is the key to success, and even if you do find me repeating myself, then it's that kind of hypnosis. It's like those advertisements on the radio you get where they mention the brand name they're promoting like 50 times in the space of a minute. It's bloody annoying, but you know what? It gets the message drilled into the listeners. It really does. Okay, so we want to treat our trading account as a business. Our key ulterior motive is to make money after we've preserved capital. Okay, and we can do this by risk management, keeping our losses to a minimum, i.e. the money placed on a trade, so if it loses, we only lose a small amount. But if we're in a winning opportunity, then obviously we want to make those winners run. So let's talk about risking 1% per trade. Well, here's the formula. If you want to screenshot of this or email me afterwards if you want the slides, that's absolutely fine. It's rob@thelazytrader.com, by the way. So anyway, working out 1%, you should never risk more than 1 or 2% of your trading account. So if, say, you've got a £100,000 trading account, you should never risk more than £1,000 on any trading decision, no matter how good it looks, okay? Because imagine if you risked 10% on a trade setup and you thought it looked absolutely amazing, it fulfilled all the rules and it lost, then you're going to get that real kind of horrible recency bias for when you get setups which fulfill the rules and you don't trade it because your most recent trade lost money and you risked a lot on it and lost a lot on it, but you don't take the next trade setup which fulfills the rules, and typically it wins. So always assume that the market could do anything at any time. If the market goes against us, we don't lose more than 1%. I'm just going to close the window because the police car outside is really starting to annoy me. There we go, that's better. That's not really. Anyway, so the formula is 1% of our trading account. Say we've had a £10,000 trading account, 1% of that is £100. So if the worst thing that happens is that we lose the trade, we lose no more than £100. Okay? So in order to find a stake size, how much we place per pip or per point, we have our entry price minus our stop loss price. The difference, it could be, say, for example, 100 pips difference between our entry and our stop loss. If 1% of our trading account is £100, then we divide that 1% of our trading account, £100, by the difference between our entry price and our stop loss, okay, to find our stake size. And that's how we trade size. That's a crucial element. All right. Moving on to a stop loss, which is very closely related in terms of like preserving capital. It's a special set of orders we have with our broker, which means that if the trade goes against us, we do not continue to remain in the trade. The broker automatically takes us out so that we do not lose any more than 1% of our trading accounts. I mean, I'm going to ask you, you're not going to go bungee jumping without a cord, would you? So it makes sense to obviously trade with the safety of a stop loss just in case the market goes against you. Remember what I said, even though those picture perfect trades can go against us despite fulfilling all the rules for entry. And that's exasperating when that happens, but you just got to lump it, unfortunately. It's part and parcel of trading. Some do lose us money, and when they do, the trick is obviously not to be dispirited when you get the next setup, because sod's law, those people who get dispirited when they have their picture perfect trade go wrong, they don't trade the next setup because they're suffering from recency bias, and of course the next trade is the winner, which makes a lot of money, and they're not in it. And that's a typical newbie's paradigm, really. And just take it from me, that's not a nice dilemma to be in, really. Okay, so trade strategies with positive reward to risk, that is pretty essential. In fact, that's very essential, especially when you're trading on the hard time frames. This is a lot more tenable on the hard time frames like the daily or the weekly. The reason is because these time frames are a lot more resistant to news announcements or intraday spikes. It's not going to be the case that you're going to be stopped out like you would be if you're trading something like the 5-minute, God forbid, or the hourly or the 15-minute. So just take it from this perspective, that trades yielding a good reward are our lifeblood, and it means that we can still make money even if we have more losing trades than winning trades. So let's go back to here. I never like trading with negative reward. I'd rather go for, if I'm risking 1% of my trading account, I want to know that I'm getting at the very least a 2-to-1. So I'm risking 1%, i.e. £100 of my trading account, that I could stand to gain potentially £200. A lot of people just go for 3-to-1, which is absolutely fine. So they're not going to take a trade setup unless they've got the potential of making 3% in exchange for their 1% risk. Okay, so remember that high reward to risk trades as well, they're not immune to news, but the great thing is with news that news can either go in favor of the trade setup or could go against it, and nobody knows the whole time what direction the news is going to go in. It's very difficult to predict news. Some people get it right some of the time, nobody gets it right the whole time. So that's the great thing about news of our trading. If it goes in favor of our trade setup and we've got a 3-to-1 trade with the potential of making 3% when we risk 1%, and news is in our favor, 50-50, then it could help perpetuate a winning outcome, i.e. make us 3% return on our trading account. If the news happens to go against us, 50-50 chance that it could, like I just mentioned, then at least we know that we risk or stand to lose no more than 1% on that. So that's the important thing about looking for trades with high reward and news as well.